There's a real puzzle at the heart of the market right now. If you look at the headlines, what investors are saying, and then what the market is actually doing, none of it really seems to add up. So let's dive in and try to figure out what's really going on under the hood. First up, let's just look at two pieces of data that feel like they're from completely different planets. On the surface, the market is sending some seriously confusing signals. And this really gets to the core question that has so many analysts scratching their heads right now. Because if you actually ask investors how they're feeling, well, the mood is just overwhelmingly negative. It's a total sea of pessimism out there.
And this is where that contradiction just slaps you in the face. On the one hand, you've got investor surveys showing that the bears, the pessimists, outnumber the bulls by almost 10 percentage points. But then you look at the actual market, and the S&P 500 is just hanging out, only 1.7% away from its all-time high. So how can both of those things be true at the exact same time?
Okay, so what is really going on? To understand the recent jolts we've seen, especially in really sensitive assets like Bitcoin, we have to look past the easy headlines. We've got to dig a little deeper to find the real story. Now, the story that a lot of news outlets ran with pointed the finger squarely at Japan. The narrative was that some comments from the Bank of Japan spooked everybody and sent assets tumbling. But, when you look at the data, that seems to have been more of a convenient distraction than the actual cause. The real answer, the hidden driver behind all this, is a concept that's maybe a little less flashy, but honestly, way more important: market liquidity. The best way to think about it is like the oil in the engine of the financial system. When there's plenty of it, everything runs smoothly. But when that oil starts to run low, the whole system can start to seize up. And that's pretty much exactly what's been happening. This essential financial oil has been quietly draining out of the system, creating this immense, almost invisible pressure just below the surface. So just how much pressure are we talking about here? Well, since 2022, the Federal Reserve has been on this mission to tighten things up. And in the process, they've pulled a staggering $3 trillion of liquidity out of this system. That's a huge amount of oil to drain from the engine. And that squeeze has been picking up speed. Just since mid-July of this year, another $600 billion has been drained away. Now, this rapid withdrawal has pushed bank reserves right down to what a lot of people think is the absolute bare minimum needed for the system to even work properly. And then a major warning light on the dashboard started flashing bright red. What you're looking at here is the rate in the repo market. That's basically where banks do super short-term overnight loans to each other. When that rate spikes, like you see here, it's a huge red flag that banks are getting desperate for cash. The system was basically running on fumes. And this is the absolute crucial point. When cash gets that scarce, what's the first thing that gets sold off? It's the most volatile, risk-sensitive stuff. Assets like Bitcoin. So that sharp drop wasn't really a reaction to some headline out of Japan. It was a direct result of a major plumbing problem right in the heart of the US financial system. There just wasn't enough cash to go around. The situation got so critical so fast that the Federal Reserve had to just slam on the brakes and step in. And the way they did it was, well, pretty dramatic. In a huge move, the Fed stepped in and injected a massive $13.5 billion right back into the system. This was like an emergency transfusion of that financial oil, forcing it back into the engine to stop it from completely seizing up. And to give you some perspective on that number, this wasn't some routine little tweak. This was the single largest one-day injection of liquidity by the Fed since the absolute depths of the great financial crisis, more than 15 years ago. So what does this emergency action really tell us? Well, two really important things. First, that liquidity problem, it wasn't just a theory. It was a real and present danger. And second, the Fed just sent a massive signal that it's going to make sure the system has enough cash to function no matter what. So the Fed just did this stunning U-turn, right? They went from aggressively draining cash out to suddenly pumping it back in. This is a fundamental change. So the big question for all of us is, what does this reversal mean for the economy, for the markets, and for your investments? And believe it or not, we find ourselves right back at another one of these strange contradictions. This time, it's between how consumers say they feel and what they're actually doing. On one side, surveys show people are incredibly pessimistic, expecting their finances to be much worse next year. But then you look at the spending data. And it tells a totally different story. Despite all the doom and gloom, Black Friday sales jumped by more than 9% compared to last year. Think about that. People are saying one thing, but they're out there spending like they feel the complete opposite.
So, how do you square that circle? Well, the most likely answer is that we have a sort of two-track economy going on. While a lot of families are feeling the squeeze, high-income earners have just kept on spending, and spending big. And their purchasing power is so significant that it's basically propping up the whole thing, keeping the overall economic numbers looking surprisingly strong. So, when you put all these pieces of the puzzle together, a whole new picture starts to come into focus. One, the Fed has totally flipped its script and is now adding cash back into the system. Two, pretty much everyone expects interest rate cuts are coming. And three, the consumer is still hanging in there, spending way more than you'd expect.
Which brings us all the way back to where we started. You have this overwhelming pessimism everywhere you look. But at the exact same time, the Fed is starting to add fuel back into the market, and the economy just refuses to crack. So the big question we're left with is this. Is the crowd, that big bearish consensus, about to be proven completely wrong?